Hello, everyone, and welcome to episode 4 of the Fireplace podcast. Me and Andy today will be talking about a few things. So, we've got a bit of news, and we'll be talking about the effect of the war on the price of shares and bonds and for investors. We've got another guest interview with a very famous interviewee this time. And we've got a couple of questions at the end about using cash and premium bonds and things like that. So, let's get started straight away. I'll hand over to Andy and we'll go through a bit of recent news.
I'll just say this very famous guest interviewee is going to be a big disappointment to everyone, but you'll find that in a minute. So the news. We've been asked about the Iran war, um, and whether people will be better in bonds during a financial shock or a political shock, as this is. 'Cause normally you would think, okay, we hold lots of shares, but when shares drop because of an event, that's when bonds bounce up in a counteraction to that and protect you. And we've looked at this, and well, that doesn't seem to be the case this time.
No, I think the traditional wisdom is that you buy bonds because when the price of shares goes down, the price of bonds goes up. And when the price of bonds goes down, the price of share goes up. And it's like a seesaw. When one goes up, the other one goes down. And if you hold a bit of both, it gives you a smoother ride.
But that doesn't happen in all situations. So what's different this time?
So yes, so what I did was I looked at the value of a global tracker fund, and then I looked at the value of a number of mixed funds, which had a mixture of global shares and government bonds. And the overall outcome, to my surprise, was they'd all done quite badly. The bond funds had done slightly less badly than the ones with lots of shares in them, but the overall picture was pretty grim. And if you'd bought a fund with a lot of bonds in it, expecting it to be doing well and quite resilient for this kind of thing, you'd have been a bit disappointed.
So I think I know the answer here. I think the magic ingredient here is inflation, or in this case, the anticipation of inflation. Because surely the effect of inflation on companies is, oh, it's doom and gloom. They're not going to do as well because then they may not make as much profit because inflation is taking a hit, and they won't naturally all be able to raise their prices accordingly, and so the profit margin will get squeezed. But then also on bonds, the bond market is no dummy. They're there looking at what's going to happen globally, and they see something like a shock on oil price, and it's harmful to bonds too. So this is one of those cases where bonds don't act in decorrelation to shares. Is that right?
It certainly looks like it. I mean, one thing we should say here is that there are some bonds, like index-linked gilts, for example, which you can buy, which give you a fixed return. And as long as you keep them for their duration, you know exactly what you're getting. But I think the effect here we're talking about is mostly on bond funds, which all seem to have gone down in value, as you say, on the expectation of more inflation to come.
Hmm. Super. So the takeaway from this is holding bonds at this time didn't benefit you. Um, I'm quite negative on bonds all the time as part of your portfolio. I think they're a bit of a broken product.
Yes, I tend to agree with you, but I think they do have some value for some people in some circumstances.
Hmm.
I'm not quite sure what those circumstances are. I'm never exactly sure what the best type of bonds to have are, but there I think there are some scenarios where bond makes sense. And one thing that comes up quite regularly, which we'll probably cover in a future episode, is the idea of having a gilt ladder so you know that at least some of your investments are going to give you a guaranteed return for a period. Although, as I'm sure you'll point out, that's quite expensive.
Yes, all of these things come at a cost, don't they?
Yeah.
That's the problem.
So I think
Okay.
we'll cover that in more detail definitely later. But I think the main focus today is our guest interviewee, which some of you may have guessed is no other than Andy.
Woohoo!
I was interviewed last week, so this time it's my turn to fire some questions at Andy around his journey from being a regular employee to now being retired. Welcome, Andy.
Thank you very much. Thank you for having me on.
So we're going to run through a similar set of questions to the one you've asked me. I'll try and make them a little bit different. And I guess the first question is, what were you doing or where were you when you first heard about the whole concept of fire and retiring early and financial independence and all that kind of thing? And the penny
Well,
dropped.
I had started investing probably something like 16, 17 years ago, and I had no focus to my investing. I got into it because a friend said, "Hey, there's this great opportunity. I'm buying these shares." And oh right. So I got interested and followed suit. This was at a point where I was probably in my 30s, and for the first time had some spare money, and there wasn't a goal for it. It was just, oh, there's a holiday, let's go on holiday, and then, oh, there's an investment opportunity, let's have a dabble at that. So I learnt investing and cut my teeth that way, and it was very messy. I lost money, and there was no great plan. But go on.
Sorry. What what did you think you would do if it went well? What did you plan to do with the money? Did you have a sort of goal in mind of buying a Ferrari or something, or was it just it's a good
No,
idea to have more money?
it was just, oh, we can make some money, and this might be fun. And I did get very interested in the company we were investing in, and I followed their progress in great detail. And when it all went south, we lost our money, and that was a great education because that for me, I had no sophistication. I was the son of a carpet fitter, very modest background. We didn't have spare money kicking around, so I remember a friend of mine talking and saying, "Oh yes, everybody's portfolio's done badly," and I remember thinking, "I don't have a portfolio. I wonder what he's talking about." So I just wasn't from that background, and
When this company failed, was it a surprise to all of you who invested?
this was an oil exploration company. So it was always a bit high risk, and they were going through a drilling program, and eventually ran out of money for more drilling without having proven their resource properly to actually get somebody to finance the whole extraction program.
Right. So
So
it
it
didn't
ran out of
collapse. It
steam.
just kind of ran out of oomph.
Yeah, there was this wonderful time. I was on holiday in Thailand, and their news came in that they what they had thought was a find on an initial drilling. Um, they they turned out, no, our reading of the seismic survey has proved to be inaccurate, and they called it the Great Oil to Water Fiasco. We'd struck brine, which apparently has a very very similar look on some of these scans. So we had great fun. It was a real roller coaster ride, and I learnt lots. But I learnt mostly about what I want to avoid as an investor. So fast forward anyway. That was in the early years, and then I came across fire in the same way as you. I first read the Mr. Money Mustache blog, and that started to give me some focus that, right, yes, I have spare money. I should be being frugal because I know how to do that, and I should be focusing on building things and buying sensible investments. In the meantime, I'd become quite a fan of Warren Buffett, and I'd read various books. I'd read The Intelligent Investor, Ben Graham, and so I got an idea about value investing and what I wanted. I, I I came to the realization that I wanted to be an owner of companies.
Right.
So in the same
Well,
way that I owned my own business as somebody self-employed, I wanted not to. I wanted to get to a point where I could not did not have to work for a living, but my ownership of other companies was sufficient to give me an income.
right. And
And that all fitted together, and this fits hand in hand with the fire program quite well, but it is a bit of a remove, and it's a different approach slightly.
yes, and your fingers being burnt on the oil exploration didn't put you off buying shares.
No, it made me realize that I needed high quality companies with lower risk. So I understood about risk very directly there, and this meant that I was very keen on let's look at the risks here because I know it can
Right.
go south. So this has slightly put me off index investing because buying the index, you do get the dogs along with the stars.
Yes. So at this time, um, were any of your friends doing it as well in this way, or were you a lone wolf in your
I
pursuit
was
of?
I was a lone wolf. There's yes, nobody in my circle. Well, after that debacle with the oil exploration company, everyone got out of it, and so there was only me learning just quietly on my own. And my partner was investing in funds and just spare money going into a pension, that sort of thing. There
Right.
wasn't much in the way of focus on investing amongst anybody that I knew.
Right. So people were investing, but they, as you say, they weren't doing it for a particular goal or particular focus, just that it was a good idea.
Absolutely. My environment then, I was working in the carpet industry as a rep, and so I was dealing with lots of small businesses, and their most obvious investment method was, well, if you've got spare capital, put it into your business where it will work for you. So they had that as an outlet for their cash.
Yes, which is, I guess, equivalent to a salary man buying into their company share scheme, but has a lot of concentration risk, as we'd call it.
Well, yes.
Because if the
Um,
company goes under, you lose your job and you lose your investment.
and then there's the question of exit strategy.
Yeah.
So I looked at it and thought, well, fine, it's okay investing in my own business. Um, which as a kid, I remember my parents' accountant telling them that your money will work harder for you invested in your own business than it will anywhere else. You can use that spare £500 to buy a roll of carpet and turn that around and make a healthier return than you will get from any investment, which was right up to a point. It
Yes.
it was investing in a way that you knew and understood. But yes, you get to a point where you think, well, how is this going to let me retire? So I need
Yeah.
to become an owner of other companies.
Right. So you'd sort of made that switch to investing outside of your own business for you with a definite goal in mind of retiring early, hopefully, or had you sort of
Yes, this would have been well, it took me 8 years to reach financial independence from the point of starting to invest properly, sensibly. And all of that time wasn't ultra focused. It did take me some time to streamline things. I became more interested in efficiency along the way and making sure all of my money was working as hard as it could be. But initially, when I came into this, I had a holiday home and the overheads of running that, and that was probably the big change. When the point at which I said, right, if I sell that capital can go into investments and feed the retirement fund, and the running costs of the holiday home can be eradicated. So that improves my savings rate.
yes, I mean that sounds to me quite a sort of typical thing to do once you've got started, you start seeing opportunities and you start re-evaluating other assets or liabilities that you have and rejigging things. But
Yes.
presumably
Well,
with
I was a
you
few
were on
years
quite
in
a
at that point.
you were on a quite a fast track to financial independence. So you were tracking this as you went quite carefully, I guess.
Yes, I would say on a fast track, not because I've ever been a massive earner, but because I am pretty frugal. I've got very low living costs. Um, we live very simply. I've not got expensive tastes. Don't have kids. I don't really drink. I don't smoke. My only vice is travel. And
Right.
prior to investing, the spare money had all gone on travel because it was catching up. Let's see the world.
And while you were doing this, presumably you were still managing to have a career, a partner, buying a house, etc. How did you integrate those things, and how did you decide whether to put everything into the pot, so to speak, and how much to leave for normal life and any luxuries?
Um, we the thing that really shifted the balance was I'm quite an environmentalist, and I wanted to buy an electric car, and I knew that this was a big chunk of money to spend, but I there wasn't a used market for electric cars at that point, really, and with my needs, I mean, we had a holiday home in the Lake District. I needed to be able to drive about 170 miles, and looking at it, there wasn't much charging opportunity around then. I needed something quite capable. So I ended up buying a new electric car, and that that then took away um, that took away the running costs of a car because it meant that I was no longer spending however much on diesel a week. Um, but it also made me think, oh, I've just spent an enormous amount of money for me on buying a new car, and I now need to frugalize in other areas to balance that. So I took the decision that right, the next few years it will be domestic holidays that I can drive to. So I
Right.
said, I don't really want to be flying if I can avoid it. So I took the decision to reduce my flying, reduce my spending on exotic holidays, and for that first period, it was trips to Scotland, Wales, Cornwall, and the Isle of Man, and kept it
Right.
all pretty simple. The pandemic then came along and made it a whole lot easier to avoid spending on travel because, yeah, who wanted to be traveling abroad even when the lockdowns were lifted? So I had a good
Yes.
run where the travel costs came right down and the car had been paid for, so my running costs were negligible.
I
And
th Yeah,
yeah, go on.
I think for a lot of people on the road to financial independence, provided they were in a good position before the pandemic was quite helpful because as long as you could keep your job, your salary would stay the same and your costs would generally go down for pretty much everyone. And as long as you didn't have to pay someone to look after the kids or do something like that, you would generally be accelerating your progress to financial independence. Not for everyone, but I think,
Yeah.
yeah, I can see that that would have probably helped. And I guess so that's the pandemic's what, a few years ago now. So when you got towards the end of your um, preparation, did you change much as you approached the sort of retirement point?
Um, Probably not. I just kept on keeping on. I was lucky enough to have a partner who was on side. We keep our finances separate, so the decision was all mine. That was great, and if anything, I just doubled down on the saving because I got to a point where I could see how much an invested pound was making me, and I did begrudge spending it on something else. So I got this sort of investing addiction where, yes, I want to make it go faster.
Yeah. And did your partner want to retire at the same time or
No, Charlotte's a few years younger than me, and um, and her parents live nearby. She's not in any hurry to be away for very long, whereas I yearn for a bit more travel. We both like travel, but she doesn't want to be away long term whilst they need a bit of support.
right?
So we've got that going on. So I mean, even at the moment, I retired 6 months ago, and Charlie's talking about maybe retiring at the end of this year, maybe next year. See what goes with the jobs, and let the needs of the jobs that she does drive things.
Right. That sounds like a sensible idea. So, when did you know? You said it was about 6 months ago. When did you know that it was time to stop work and to actually pull the plug?
Well, it hasn't just been financially driven. It wasn't a case of getting over a finish line and saying, yes, right, done, the figure's achieved, off we go. Uh, in parallel with this, I've got a little bit of a physical business, or it was a physical business. Because for all that running a carpet and bed shop, you spend a lot of your time waiting around for customers to walk into your shop. Occasionally, this delivery van will turn up and there'll be a lot of carrying things on your shoulder. And I was suffering the wear and tear of this. So early last year, I think it was February last year, um, I'd been referred to a specialist, and they said, yes, what's going on with your neck? All these headaches and neck pain. This is something called spondylosis, which is sort of normal wear and tear of the vertebrae, but its nerves are being brushed by things, and what you're doing is aggravating it to a degree, but that's life. And so I thought, yes, okay, they're not telling me you need to give up this job, but it was apparent that this job is not doing me much good health wise.
No, it's a kind of sign that maybe time to start thinking about it. Yeah.
Yeah, some of these things, it's a young lad's game, and it's time to get out. So I said to myself then, I don't want to do another winter of being in a cold shop. So I started casting the net about for was anybody interested in buying the business? And it was not going to net me very much because there's not much cost, there's not much barrier to entry to opening a carpet shop, because anybody can pretty much open the door, get some free samples, and off they go. But I did have the advantage that it was a business that I had bought, and it had been a carpet shop in that location for nigh on 30 years. So there's got to be a value to that. And I found a friend who I'd known for years, and he's taken it over. And so I stepped away on the 1st of October.
Congratulations. So well done.
Thank
And
you very much.
having moved into retirement or financial independence at least, is there anything you would have done differently early on, looking back?
Um, well,
I mean, we all wish
I
we'd started 5 years earlier. That's kind of a
yes,
given.
I look back now and think, ought I to have done another year or two? Because the numbers, by the numbers, I should have carried on a bit longer. But
Right.
I'm quite an optimist, and I look at the portfolio and think, actually, that's going to be okay. I'm not going to run out of money anytime soon. But it has left me feeling that, am I fully retired forever? Will I do a bit of something? So I'm kind of calling it coast fire. Um, I've I've got a few little bits and bobs that earn me money. I mean, I've got the income from the writing of the books,
Yes.
but I also I've been as soon as I said I was selling the shop, an old friend in the trade said, "Would you fancy being a sales agent for us, just on a part-time basis? Whatever you feel like, a day a week or something." So we've got that looming that might keep me out of mischief for a while as well, and
Yeah.
and take and soften the impact on the portfolio of trying to fund everything.
And also, I think soften the psychological impact a bit. Um, I think,
Yes, there is that. I've I've struggled in some ways because it was a poor choice really to retire just at the start of the winter months,
yes,
especially when your partner's not yet retired.
I think
So
that's a big thing, which was probably for another episode, is managing uh, retiring as a couple, because if one of you retires before the other, there's obviously the obvious issue of jealousy, which you've obviously managed and discussed. But there's also the point that a lot of the things you'd want to do when you retire, you'd want to do as a couple. And if one of
yeah,
you's still working, you can't do those things.
absolutely. I mean, I rather like New Zealand. I've been to New Zealand 3 times, and I'm quite keen to go back for a fourth. And I talked about going this last winter and dithered over, do I want to do it on my own? Because I've done it on my own before. And what I wanted to do was do it with Charlotte, because we've travelled out there before and had a great time. And we've got friends out there, and that would be wonderful. And we didn't do it because A, she's working, B, she's worried about her parents' health and being around, and didn't want to be away for any extended period. So in the event, I didn't go. And I'm kind of regretting that because this winter has been a bit dull. And so I'm looking forward and saying, actually, I think next winter maybe we'll do that because
Yeah.
she's now saying a little bit more, seize the day, take your opportunities, and maybe she'll come out for part of the time. But the thing that I did do right with the start of retirement is on day one, I changed the nav in my car and I had it set up that work was the carpet shop. And I changed over work to a little spot in the Peak District, well, in the Derbyshire Dales, where is a parking spot that I could go and do a walk in all conditions, which is a nice intensive walk up a big slope. And I've pretty much done that every day through the winter. When I've been around and not distracted with anything else, I've gone and got some exercise. And that was great because that gave me a morning commute and it replaced my prior morning commute. Go out, do an hour or two's walking, and then there I am. Ooh, do I go home for lunch? And do I go out for lunch? Do I meet a friend? I've got the afternoon free. So it turned it into just, it turned it from being a vacant day into, oh, I've got a bonus afternoon. What shall I do with it?
Yeah, I think that's very important. I think it's another topic we'll definitely come back to is any bit of routine you can add, however small and however made up, can make life a lot easier if you're used to a Monday to Friday routine. I mean, one thing we joke about is that having both retired, especially in the school holidays, we never know what day it is, but it is handy. I volunteer 1 day a week, and I have a few other things at various points in the week, and I think they do help a lot to kind of anchor you so you kind of know where you are in the week and sometimes in the month as well. Well, thanks,
Yes,
Andy. That was really good and really interesting. Um,
super.
I'm sure there's plenty of things we'll come back to there. Um, and I think that covers the main part of the podcast. We've just got a couple of Q&A questions we were going to cover next.
Yes.
Um, the first one I was going to ask, which was how much cash should I be keeping um, on the way to retirement and in retirement?
I'm always reminded of Warren Buffett's quote on this. Buffett's one of my heroes. He said, cash is like oxygen. If you find yourself in a point where you haven't got enough of it, then it's a very pressing problem. But beyond that, having more than your needs doesn't gain you anything. And of course, it comes at an opportunity cost because cash is never going to be a very productive investment.
Absolutely. I think one thing we say quite often, or we see this in our group, is you have enough cash to last you as long as you think you need to, but that depends on how safe everything else is. If you're self-employed and your jobs are only booked in for the next week or two, then you probably want to have quite a lot of cash in case those jobs dry up or there's a recession or something else. If you're in a very safe salary position with a 6 month notice period, you're probably not going to need a huge amount of cash. Um, and I think in the same way, if you're retired and you're living off your investments, you're probably not going to need a huge amount of cash. And I think the exception would be at the start of retirement. I think people generally agree that that point of transition from work to retirement is when having a nice, reasonable pot of cash can help both in terms of your finances, but also it helps the psychology as well. And I think it helps you to gently start using some of the cash before you go headlong into selling assets.
Yes, and that cash at the start of retirement is also a factor in your management and treatment of sequence risk, which is a way bigger subject than we can cover at the
Yes,
tail end of a podcast. That's one for
exactly.
another day.
Yeah. And I think the other question we had was what about other things that are like cash, but not actually cash? So premium bonds, savings accounts, money market accounts, and those kind of things, cash ISAs, those kind of things.
I frequently come across people who have got an awful lot. They've maxed out premium bonds and they've got a lot of investments in cash because they're scared of investing.
Yeah.
And you look at the return that it gives, and I say return, it's often lower than real inflation.
I think
And
that's an important point, really. I think the elephant in the corner of the room of all these discussions is inflation. And I think most investments or most cash or cash equivalent savings or investments aren't really going to give you anything above inflation. So in real terms, your money is pretty well sitting still.
yes, whereas investing in companies, well, if you invest in decent quality companies, they've got pricing power. They can raise, if you're a customer of Apple and Apple say, oh, we're going to up the subscription rate on our storage product by the inflation rate, you as the consumer, you suck it up and say, yeah, okay. You're not going to say, I'm not going to buy that anymore. So companies tend to have pricing power in a way that other things don't to deflect inflation.
Yeah, I think this goes back to our point at the start of the podcast where we talked about shares and bonds and how things are, bonds particularly, are very um, sensitive to talk of inflation. And I think by the same token, companies are less exposed to inflation because they can put their prices up.
Yes, I mean, it does hurt. It hurts everybody. Inflation serves no one well.
Yeah.
And I fear we are in for a time of inflation following the pandemic and all the debt that came about because of it.
Yes, there's a lot of potential causes of inflation that have been lurking around, and adding a big war into the mix and the potential rise in the price of energy isn't going to help that. On which gloomy
Sure.
note, I think we should maybe just say to everyone to remember to subscribe to the pod and like the podcast if you found it useful. And we'll look forward to hearing from you next time.
Thanks very much.
Okay, thanks, Andy. Bye for now.
Bye bye.